Imagine a scenario where the world's most prestigious universities, institutions like Harvard and Yale, are offloading billions in their private equity holdings. And here's the kicker: the buyers of these stakes can immediately turn around and report one-day windfalls of 1,000% or more. It's a financial maneuver so wild, one expert said, it makes your brain melt. This isn't about distress, it's about a fascinating intersection of elite finance and market mechanics, revealing the complex, often opaque world of private capital. Harvard and Yale are among the country's most elite institutions, and they're actively selling parts of their massive private equity portfolios. Yale is negotiating a nearly $3 billion sale of its private equity holdings at a discount of less than 10%. Harvard has agreed to sell roughly $1 billion of its private equity stakes following a similar move in 2021. Why now? For these venerable endowments, it's about seeking more liquidity and flexibility amidst economic turbulence. Marcella Rooney, a spokesperson for the Yale Investments Office, confirmed this deal is intended to convert private equity assets into liquid assets for reinvestment, calling it standard portfolio management. However, some industry skeptics believe these sales highlight growing concerns that returns in the opaque world of private equity aren't always what they're cracked up to be. Nir Kaisar, founder of asset management firm Unison Advisors, suggested these sales signal a big reveal for private equity. Yale's $41 billion endowment, with about 95% allocated to growth-oriented assets like private equity, venture capital, and real assets, generated returns of just 6.7% last year, underperforming the S&P 500 and other indexes. This comes as private equity and venture firms have struggled to sell their stakes in companies and return cash to investors, significantly driving down returns.
Indeed, data from PitchBook shows private equity firms generated average returns below 10% in 2022 and 2023, and just over 10% in 2024. This is a stark contrast to the mid to high teens they reliably generated for over a decade after the financial crisis. Deal-making has been slow for several years, and cash returns to investors have plummeted from 25% to 35% in prior years to just about 15% in 2024. It's also happening amid a challenging political climate. President Donald Trump has targeted university finances, including a possible tax hike on endowments and decreases in federal research funding. Congress is pushing a bill to increase the tax on university endowment investment income from 1.4% to a hefty 21%. Yale is grappling with decreasing federal research funding, and its current endowment spending of roughly $2.1 billion for 2025 accounts for over one-third of its annual budget. While Yale maintains that private equity remains a core element of its investment strategy and it's not reducing its long-term target, this move is widely viewed on Wall Street as a harbinger for other investors. Sandeep Dahiya, a finance professor at Georgetown University, described it as significant, noting that the lead architect of investing in the private equity markets is pulling in its horns. For decades, Yale has been a pioneer in shifting investments away from traditional stocks and bonds into alternative assets like private equity and venture capital. This approach, famously known as the Swensen model after Yale's late chief investment officer David Swensen, saw the university's endowment swell from $1.3 billion in 1985 to $42.3 billion by 2021. Other universities, captivated by Yale's impressive returns, followed suit, significantly increasing their private equity allocations to an average of about 17.1% of assets. As Ludovic Philippou, an economist at the University of Oxford, put it, the pitch to other investors often sounded like, do you want to be smart like Yale? This fostered a symbiotic relationship between universities and private equity firms, with endowments paying roughly 2% of managed money and 20% of profits, minting billionaires, many of whom sit on university boards and make large donations. Joshua Bekenstein, Yale's senior trustee, for instance, has worked at Bain Capital since its inception. However, unlike publicly traded stocks, private asset valuations are often based on subjective assumptions and don't fluctuate daily. Private equity firms make money for investors by exiting investments, converting notional valuations into cash. If the broader economy struggles, opportunities to sell assets decline. Bill Ackman, the CEO of Pershing Square Capital and a Harvard alumnus, has publicly claimed his alma mater's $53 billion endowment is significantly overstated because public markets would value private assets lower than their private carrying values. Yale's sale, codenamed Project Gatsby, to keep the process discreet, involved
involved offering potential bidders a combination of core funds they most wanted to sell and sweeteners, better performing ones. This mosaic deal allows buyers to choose specific investments. Yale's bankers at Evercore Partners initiated the process in April, aiming for a June 30th closing. Among the specific funds involved, Yale has been shopping a roughly $600 million stake in a 2007 fund run by Golden Gate Capital, known for its investments in retailers like Ann Taylor. This was marketed as part of the core portfolio. Yale has also offered to sell 9 funds managed by Bain Capital, totaling about $1 billion in value, with about $500 million of those stakes near sale. Other firms like Insight Partners and General Catalyst are also part of the portfolio being offered.
Buyers of these stakes include prominent firms like HarborVest, Blackstone, and Pantheon, while universities are selling their stakes at a discount to the net asset value, or NAV, on their balance sheets. The demand in the secondary market is booming. Secondary sales increased a remarkable 45% to $162 billion last year. Here's where it gets wild and where the brain melt happens. Buyers are allowed to acquire these stakes at a discount, then immediately mark them up to the original net asset value. This process, called NAV squeezing by investment veteran Tim McGlynn, creates those staggering one-day windfalls that buyers then report as real returns. While permissible under generally accepted accounting principles, or GAAP, Jeffrey Hook, a finance lecturer at Johns Hopkins, agrees it looks quite shaky, describing it as almost like a full wash and rinse cycle. Even with the discount, universities like Yale can still walk away with a profit on their initial commitments. Yale's spokesperson described their deal as standard portfolio management, not an emergency sale, allowing them to offload older or lower performing holdings and reallocate capital. Joshua Cascade, a professor of private equity at the Yale School of Management, commented that Yale is selling at a time when the upside to private equity is probably the least it's been in years, and noted they are smart to sell now before other institutions flood the market. Indeed, Yale's move is seen as a wake-up call for investors, with Lawrence Siegel, a former director of research at the Ford Foundation, suggesting Yale is trying to get out before everyone else. Other major institutions, including MIT, whose endowment is run by former Yale Investments Office director Seth Alexander, are also reportedly exploring similar private equity sales. The New York City retirement system, managing $280 billion, recently sold $5 billion of its private equity stakes, with Chief Investment Officer Stephen Meyer acknowledging that returns had, quote, haven't been great and were disappointing. This unprecedented unloading of private equity stakes by leading endowments marks a significant moment, reflecting deeper trends in the private markets, institutional investment strategies, and the ever-evolving landscape of high finance. Thank you for tuning into this deep dive into the world of university endowments and private equity. Stay informed, stay curious.